With technology becoming more important, how has that affected the M&A space for these companies?
Most of the larger mining technology companies have been acquired. With that happening, anything that was probably over $20 million or $50 million worth of market value has been swallowed up by the majors.
We're pleased to be joined today by Ivan Gustavino, a seasoned corporate advisor with over 25 years of experience working with high-growth companies in the mining, technology, and industrial sectors. As managing director of Atrico, Ivan has played a key role in more than 100 transactions involving strategy, capital raising, and mergers and acquisitions. He's known for helping founders and boards navigate complex commercial decisions, scale their businesses, and prepare for successful exits, especially in capital-intensive industries like mining tech.
What have you seen in the mining technology sector that has evolved over the last decade?
The evolution has been around more the mining companies' willingness to start adopting and seeing technology as important to the way in which they mine and the way in which they're able to extract value.
When evaluating mining tech companies for investment or for acquisition, what are the main things that you're looking at?
The team who built the technology, who have actually built the commercial model and have been successful at scaling the business. The intellectual property is critical in terms of where those companies are looking for a differentiated advantage. The rate of growth that is in that company, so is it growing at a 20% CAGR or 30% CAGR, is quite important as well. The ability to integrate that technology in an existing business, or whether it's going to be expensive for the acquirer or easy to do. Just ask the big blockbuster question, I think. The big blockbuster question, because I think what we've never seen in the industry till the last 5 years or 4 or 5 years has been the...
Thank you, Ivan, for joining us today. To start off the interview, it would be great to find out a little bit about your history and maybe some of the deals that you've been involved in over the years.
Okay, history-wise, many years ago was part of the team building a company called Serpac, which became quite an important software business for the mining technology arena globally, and that now is called Dassault Giovia. Subsequent to that, was involved in advising venture capital groups and investment banks on investing in technology companies, and learned a little bit more about how the money works. And then obviously the last 20 years with Atrico has been advising mining technology companies on transactions, mainly on mergers and acquisitions, and selling sell-side advisor to those companies. A couple of the most recent transactions we've been involved in, K2Fly was a client of ours, and we were advisors on the transaction to AKKR. Wow. Who recently acquired them. That was a listed Australian technology company in the environmental space. And another recent transaction would be, we were advising Geoscan, which is CoreScan. They were sold to Epiroc, and they're probably two of the most recent. We've done over 30 deals, probably the leading advisor in mining tech globally.
Excellent. And your career spans, obviously, decades. You have a ton of experience. What have you seen in the mining technology sector that has evolved over the last decade?
I think the evolution has been around more the mining companies' willingness to start adopting and seeing technology as important to the way in which they mine and the way in which they're able to extract value. And that shift is occurring with the new generation of leadership that's coming into mining companies, and who are more attuned to using technology in a daily manner. And their behavior now is much more willingness to bring on new technologies into their planning, and to allow them to increase the benefits to their business. And in the technology companies themselves, we've seen waves of new technology, especially artificial intelligence, in the last 5 years, 6 years, coming in and being a major disruptor to all industries, but in mining particularly, it's coming in and being applied, where applied appropriately, is changing the way mining is being done.
And with technology becoming more important and more at the forefront, how has that affected the M&A space for these companies?
Yeah, I think there's been a massive series of acquisitions occurred over the last 5 years, 6 years, and most of the larger mining technology companies have been acquired. So with that happening, anything that was probably over $20 million or $50 million worth of market value has been swallowed up by the majors.
Wow.
And so the trend now, and what is exciting is the last 7 years, those new companies are becoming very interesting for the next set of acquisitions that are going to occur. And that is, there's many companies, new technology companies that are interesting, having an impact. And we see that there'll be another series of consumption by those larger groups to acquire these companies over the next 5 to 10 years.
So you mentioned that the larger mining tech companies have been purchased. And so are you seeing that there's a trend to purchase even smaller companies, newer companies?
I think there's risk in doing those purchases.
Yeah.
So some companies are willing to take those risks where they're just buying them for the pure technology and they'll integrate them in their business and extract value later. Generally, these companies, the larger ones, like to find something that is more mature.
Exactly.
And more able to be integrated as a division in their organization. The ones that are willing to take some of those earlier risks are, they're few and far between. But we're seeing a bit more of that now because there's a lack of companies to acquire.
We've seen a trend where there's smaller companies and the larger companies are taking maybe first an investment in them and then watching them through. Is that a trend you'll see?
It's one I'd advise against.
Yeah.
Because generally by having those larger companies take a component of the company, they tend to block the value for the shareholders in the tech company, the smaller tech company later when they want to sell.
Yeah.
Because they're already in that company, and strategically they're looking to acquire it later in their own game plan. This is the large company, and sometimes that can actually take away value from shareholders. So generally, we wouldn't advise groups to bring in strategics that early.
Yeah.
There are obviously, like anything, there are special circumstances where we might suggest to do that. But generally, we don't think it's a good idea.
And in terms of trends that you're seeing with mining tech M&As, is there anything particular that stands out to you that is happening right now?
I mean, the trend is large valuations have occurred. So if you looked over 5 years ago, you might be selling companies for 3 times earnings. That now is 10 times or larger.
Wow.
So it's a significant shift in terms of valuation and the way in which those companies are being viewed in terms of value that they're going to be able to deliver to those larger organizations.
What is driving that shift in valuation?
I think people are understanding that there's to own a position globally and to actually have that and hold that position as a strategic move, you need to have good technology in the account, and the account is with the major mining companies, and there's few and far between, and therefore that value is a supply and demand effective condition where there's lack of supply, so that's driving the price up. But also the software side of the businesses have recurring revenue, and everyone is chasing recurring revenue. So they look at ARR as quite a good way of de-risking future value.
Perfect. When evaluating mining tech companies for investment or for acquisition, what are the main things that you're looking at?
I guess the team, who built the technology, who have actually built the commercial model and have been successful at scaling the business one way or another, maybe into an account or globally into different geographies. That team is pretty important in terms of any acquisition, as the buyers always wanting to know that they're going to get a consistency post the transaction of more growth and or sustainable growth to which they're interested in the first place. The technology itself, in terms of what is it costing to maintain that technology on an annual basis, and how stable is that technology is quite important the intellectual property is critical in terms of where those companies are looking for a differentiated advantage, and generally that is in the intellectual property. So if it's patents or copyright and trade secrets and trademarks, that's quite an important part of any transaction. We look at that to make sure that that value can be determined by the buyer. I think the growth side of the business, in terms of the rate of growth that is in that company, is always exciting. So is it growing at a 20% CAGR or 30% CAGR is quite important as well, to look at that growth, because the acquirer is also looking to see further growth post-acquisition. The ability to integrate that technology in an existing business is something we look at as well, whether it's going to be expensive for the acquirer or easy to do, and that would tell us whether that's going to be a good target for us to work with and be able to market globally.
Excellent. And we're seeing right now in the mining industry in general, the sales cycle is quite a bit longer than in other industries. Does that affect the growth rate of a lot of these companies, or the expectations of how fast they will grow?
I think to the buyers that are in the market, they understand that mining cycle. Therefore they can get their heads around that during the acquisition. But that is changing as well. And we like to, if we're advising a group prior to a transaction and we can bring some value to the table, is to get them to think about speeding that up. The mining companies don't have to take that long. And one of the trends that are out there is a lot of people doing proof of concepts, and there's many proof of concepts that don't become commercial. And we find there needs to be a way of commercially engaging with the mining company to make sure that you're not put into a POC type of place. You need to be able to say that you have value, you're delivering that value, and get paid, and change that cycle from maybe 18 months to 6 months.
Exactly.
We've been able to achieve that successfully with some of the companies we've advised.
Wow, really, really interesting. For founders considering an exit, what advice would you give them to prepare the company for acquisition?
Yeah, it's a big question. Actually, there's about 50 pages of preparation there that require. The key things is their own, to be prepared themselves to go on a particular journey of due diligence, where being very transparent, being very open with how they've got to where they've got to and where they can go to in the future, I think is critical, and sharing that transparency with the acquirer, but themselves as founders being prepared to be open and engage in an open manner, because I think the buyers always understand circumstances. They've just got to be clear and share them. The other key things for founders would be what is going to happen after the acquisition. Are they going to be important? Are they going to be going forward with the acquisition? Is it going to change the way they're seen as making their decisions, which they made alone, and now they won't have that decision-making power anymore? How's that going to affect them post-acquisition is something we want them to think about, because that could be a problem for the buyer if it's not clear, and a problem for them if they realize they don't make those decisions anymore.
I wanted to ask you that because a lot of times the founders, it's their baby, and they've been growing it. Is there something that, everyone wants to sell their company, but at the end, I think a lot of times, do they expect that big of a change, or is it quite the shock after they're acquired?
There's a bunch of companies that are quite shocked post-acquisition, those founders who've had that maybe 20 years or 15 years of making every decision on a turn of a dime and really quickly. What we do in terms of our process, one of the key things to being successful for us has been culture alignment. So by getting the founders the right home in the next stage of the venture, because it's going to go forward, it's a big part of actually the success of mergers and acquisitions, is to make sure they're going to be a cultural fit after the acquisition. And we have probably a really high success rate of post-acquisition, founders being happy for another 5 to 10 years.
And would Atrico and would they stay involved after post acquisition for a little bit of time, or how?
Sometimes we stay involved in some of those transactions. There's an earn-out component, and our client, as in the target that's being sold, would say, would we stay with them and keep assisting them with maybe achieving their earn-out targets? And, on sales, for instance, where we can be, giving our advice on how to scale further. And they're happy to do that, and we are retained post-transaction in some instances. Not many, but some.
Which operational or commercial elements most influence the valuation of a company during that acquisition process?
The key things they tend to be financial. So these are around how they're building their ARR or sustainable revenue in terms of growth. The focus is on the finance side of things. In terms of operations, I think it's really around execution of marketing and sales, because most of the companies we're selling are going into a larger group, and then it's really about how effective that can be leveraged in the hands of the buyer. And that's where a lot of value gets created for the buyer post the transaction. Whereas, the founders are taking money off the table, the buyer needs to create more value and get their returns further down the track. So that end of the marketing and sales component becomes very important, the commercial side of things.
Over the last decade that I've been involved in the mining tech industry, I've seen a big change and growth towards some type of recurring revenues. How important is that to buyers to have that recurring revenue rather than just one-off projects?
Yeah, it's super important. In terms of those valuations, you're not going to get those high valuations if you're not able to demonstrate that you have a ARR component that is growing, maintainable, and repeatable. And that is why they're paying so much for the companies, because they can see they can grow that into their own distribution further. And the ARR is the key thing to demonstrate that you have a business that is not one-off, and the mining company has a reliance to run their operations and their production on your technology. Could be software, could be hardware, but that is quite a key component in terms of any valuation event.
And are you seeing companies that previously had, one-off projects, and how are they shifting their business to have that reoccurring revenue?
It's quite a tricky maneuver to do, because there's probably a psychology around people that think in project-centric manner. They go after a project, they deliver the project, and they think in an engineering term, that's it, it's done. They have to overcome that to know that there's got to be something there that is demonstrable and repeatable, and that in itself isn't easy for a lot of people. So we have taken services businesses and turned them into software companies in our history, advised them on how to do that shift. And it's generally a three-year type of turnaround or restructuring exercise, because a lot of the people change in that, because they're generally project-centric in the way they think and operate, rather than product-centric in the way they think and operate, which is where you've got to take
big change
them.
in the mindset.
It is a mindset change, and pretty significant,
You are speaking with all the different stakeholders in the industry. You're dealing with the tech side, the actual smaller startups, all the way to the more established, but you're also speaking with the larger companies that are purchasing. And is there some emerging technologies that you believe potential buyers are looking for in the future?
Yeah, I think the future is people want to look at the whole value chain in mining, and they want to have, if they can, deliver and be part of delivering that whole value chain. And so within each of those buyers, they tend to have their white space that they're looking to fill, to secure that broader mandate with the mining companies. So there's nothing in particular, it's all across the value chain, but it's for the buyer itself might have a space that they want to fulfill. And then they're looking in the market to acquire a company that addresses that white space for them. In terms of what's hot right now, AI is hot.
Yeah.
Machine learning's hot. In terms of some of the projects that are going on in that space, a lot of it's yet to prove the value. And a lot of it is project centric and isn't going to work. But there's been a lot of money spent by mining companies, by mining tech companies, by the buyers to add a lot of value there. But they're yet to see those returns. It's still project by project and not repeatable in the AI ML space. And then further down in processing side of things, like you have lithium in Chile, it's very important. So people are looking at new extraction and processing technologies that are coming and being tested at the moment all around the world. That is quite an exciting area for investment side of things. That is, yeah, we've seen a massive demand in that area for acquisitions or investments.
Really, really interesting. You're often getting involved with companies at a pretty early stage before they're actually ready to sell, and you're preparing them and your team is working with them. What are some of the most common internal issues you see in companies when you first get involved with them?
Maybe a lack of sophisticated processes to demonstrate repeatability of how they produce their products. How do they go to market? How do they sell? That type of robust maturity isn't in those companies, and some of those processes need to be addressed so that you can demonstrate that you can achieve that. So they've got gaps in the way they're commercializing and gaps in the way they're engaging. They might be taking contracts from mining companies rather than giving them their contracts. That's quite a key gap that we see in the lack of maturity. And when you sell a company, it's very hard to deal with 25 different contracts instead of your contract one that your mining companies have taken from you. So we address that sometimes by cleaning that up effectively before the sale process. Intellectual property, they might have had someone do a piece of the technology, a sensor, a bit of software, but that person has left the business and they haven't got a clear assignment on the intellectual property rights. So you have to make sure that is ready to go and cleaned up before you take anyone to market. There's quite a lot of things like that that are pretty normal in terms of early stage growth companies, and they haven't quite got to that maturity yet. And most of those things can be addressed with a bit of time and a bit of effort.
So, in startup companies or small technology companies that are growing, often, we don't have the time to think about all these little details that you've just mentioned. So what would be your recommendation that these founders hire someone to come in and start working on these processes and systems, or how do you start to go through this checklist and deal with these things?
Yeah, it's a good point. Every one of those companies can be at different stages, and a lot of people have brought in groups to do that work, and they tend to overpay for lack of value out of that exercise. So the question needs to be, what stage am I at and what maturity would the buyer expect from me right now, rather than getting everything done? Because a lot of people would say, you need this process, that process, or this set of documentation for your technology, but you could be overspending on those things if you're not at the right stage. So I think it's right thing at the right time. So we would go in and say, this is what we need to do to get you ready, and this is what the buyers would expect you to be at, rather than let's get everything done. You'll never get it all done. There's too much to do. And to prepare someone, they could look at all the due diligence on the internet and say, oh my gosh, I haven't got any of these things. Do they need them all? Probably not, but they do need some key things in those due diligence checklists.
And what would be some of those key things? IP?
Well, yeah, the IP, employment contracts need to be standardized. Your software needs to be, any dependencies on third-party licenses for your technology, whether it be software or hardware, needs to be clear and stated, and you need to have the rights to get access to that. Your agreements with distributors need to be understood. What term are they for? Can you terminate them. All of those key contracts need to be addressed, but they're the high level.
Great. Obviously, there's companies that are looking for strategic buyers or others that are going to be, bought by for financial reasons. Is there a way that they should position themselves differently depending on what type of buyer is going to purchase them?
Absolutely. Yeah. There's a lot of work to do. We built a model ourselves at Atrico, which is we start with the exit in mind, and then we look at what categories would be interested in buying the asset, the company, and then we would actually position the business to be attractive to that particular buyer. And if it's a financial buyer, then you'd be leaning more on, the maturity of what they're looking to see. It's a bolt on, if you like, and they just want to see the numbers effectively. They want to see clarity on repeatability. The other side of that equation being tech, they want to be highly differentiated and actually have something that is able to be defensive in their strategy.
Exactly.
So you'd be leaning more onto the tech side and on the strategic buyer end, to the finance side on the traditional financial end.
And in terms of companies, the mining industry is spread across the world. There's a lot of different mining regions that are quite important. How important is that geographic growth in
Just
terms?
ask the big blockbuster question, I think. The big blockbuster question, because I think what we've never seen in the industry till the last 5 years or 4 or 5 years has been the geopolitical influence. And we were involved in a transaction. I won't name what it was, but the transaction was done. It was a very large transaction, $1 billion size. And the transaction did not go ahead because of a geopolitical issue. And that is the type of thing that we thought we'd never see, that those deals can be blocked for political reasons. And in this instance, it was. And we're seeing more of that trend now than we've ever seen. And we're seeing new actors appear, new financial banks, investment houses coming in to act and play out a geopolitical game plan. And that is influencing valuations, influencing who you're going to sell to or who's going to buy. And so, almost an arms race in technology. And that, I think, is going to increase.
Wow.
That's the biggest dynamic I've seen change in the last, 30 years. Yeah.
Wow. You've worked with a lot of different founders and business owners. In your opinion, what are some of the negative qualities that you've seen in founders that they should try to improve, or maybe some of the positive qualities that you think are very important?
Founders are all mad. So they have to be to take on what they do. They have to walk through walls and continue to do that to build some great companies. And that is a quality that all of them have there. They are, they like a challenge. They like to be able to take that challenge on and succeed. The qualities around that, I think, I guess the determination is critical in a founder, and whatever they can do to, bolster themselves up and make sure they have that quality. Did you say the negative qualities or the
both positive and negative? I think we can learn from both.
Okay, well, the negative ones are where they're in a vacuum making those calls and not making that broader amongst their team. So they're not communicating well enough to the team about the challenges they face. They sometimes can lock themselves out, and that could put them in a dark place. And we've seen some founders hit those dark places when they're challenged. So I think by opening up a bit more, they can share a bit of that weight that they carry in terms of making those calls. As if it's a two-person founder team or a 3-founder team or a single founder, they can have a lot of darkness in their journey to become successful. So sharing that is one thing. The other negative things, I think, building businesses ahead of where they're at and spending a lot of shareholders' money is something we've seen a repeatable pattern. They tend to get ahead of where the sales are at, and they put in infrastructure, hire people, and then they haven't got the sales to feed that particular pipeline of infrastructure that they've put in place to scale the business. So they're just maybe 9 months or a year too fast ahead, and then they haven't got the money, and then they're in trouble. And we see that as a repeating pattern in quite a few founder thinking. I don't know where they get that advice from, but they tend to act that way. So I think if they could try and get the appropriate advice or look to scale maybe 3 months ahead rather than a year ahead, and therefore be a bit more prudent around how they make those calls and those decisions. Yeah, the positive elements of founders, I think, is just that grit, and it's a requirement, especially in mining, because of the slow decision making that's been apparent in the past. I think that's changing, but you've got to put up with a lot to break into the mining industry and do that on a global basis in a repeatable, successful way. And my hat goes off to all of them, because it's a tough business.
Tough business.
Yeah.
One of the trends that we're seeing is that there's a lot more interest in the mining tech sector. Yep. Traditionally, it was the typical OEMs, but now we're seeing money from the United States, from venture capitalists are getting into it. How has that affected sort of the industry and how things are moving?
Yeah, I think there's been a massive effect in terms of that interest level and the type of money that's flowed in and what it's doing to transform the industry. And I think it's very positive in the main. There are some issues and some negative ones I'll share with you, but like we've seen billion-dollar company valuations we've never seen that in the past. So, groups like Cobalt Energy out of the US is now worth $3.2 billion in terms of market capitalization. And it's a company, with artificial intelligence to locate new minerals, which looks like it's becoming vertically integrated today. We've got Fleet Space in Australia that I believe has become a billion-dollar company, and the last raise that they've done as well. These are stories you just would never hear about in the past, and that's changing. And that money investing in those companies is changing the industry as such.
Previously, we talked about how a lot of the companies that were purchasing these startups or technology companies, they understood the industry they've been working in. They understand the sales cycle. Now we have new money coming in. There's new expectations. They don't quite know the industry. How does that affect these startup companies that are taking this money?
Yeah, that was the negative bit I was going to talk about. I think the venture capital industry, would look at the hockey curve type of scale. If I give you $10 million, you should be scaling that and giving me a return very quickly. And when they get in, they put that money in, then they've got to observe that the company isn't growing at the rate to which they're used to. And they've generally come from an industry which has got fast adoption and can scale quickly. And then they come into mining and watch that money doesn't have that significant hockey curve type of return basis. So the negative is there's a few investments that have been made over the last 3 or 4 years where maybe $30-40 million has gone into 3 or 4 different companies, and most of them have actually hit that turbulence level now, and they're being they have to be reconstructed and take on new capital to continue growth. But the venture capital groups are not happy with that type of outcome, but they didn't understand the industry as well as they should have done coming in, and I think their expectations were high. And of course, founders are not going to do anything other than probably gild the lily a little bit around what their expectation is on a return down the track, because they themselves probably haven't done an exit, and so they're happy to say that they're going to be $1 billion company where there's not many $1 billion.
It's not so realistic sometimes.
No, but they're chasing money and money's chasing them. So these deals are getting done. I think the maturity is coming in now. I think there's a bit more data for groups to look at, more people to talk to about those journeys, and more metrics to understand in terms of timing of the return. One of the areas that I think is yet to see an impact is the clean energy space in mining, and those cycles are longer than what the investors thought they would be.
Yeah.
So instead of being 7 to 10 years, they're going to be 15 to 20 years. And I think there's going to be a bit of a shake-up going on around valuations in that particular segment in the next short while.
Outside of the mining sectors, is there any other sectors that interest you for technology companies?
We're primarily focused on that space, but I'm interested in all types of technology. But in terms of the Atrico business, we're focused on mining tech, and industrial technology is a great place to be right now. In the B2C space, if you like, I think with AI coming in and the speed at which that market can move and change is astronomical, and you need a lot of money to be in that marketplace and change that. Mining and industrial tech, you can't do that overnight. It takes a lot more. It's complex to deploy, it's complex to build. So in terms of an area of interest is industrial technologies. Space technologies is something that's quite
the next
interesting.
frontier.
Yeah, I mean that's joined up with mining, and we've recently put a strategy together to address that space and mining technology arena. We think that's a growth area.
Very interesting. Well, I hope that I can interview on that in the next 10 years. We have more to talk about.
It'll be fun. Yeah, it's a massive growth industry. Yeah.
Awesome. Well, thank you for your time today and sharing your experiences with everyone. And I really appreciate everything that you did.
Yeah.
Thank you so much, Ivan.
Thanks a lot.